Okay, so what we want to talk about now is still related to a portfolio, but starting to talk about the relationship between the portfolio and the way in which we think about investment. So there's a couple of things about portfolio that are quite important. The first of which is we have to talk about what the goals are for portfolio management. So Robert Cooper kind of crystallized this down to three different areas. The first is to value maximize. In other words, try and get the best from the portfolio that we've assembled to go after our innovation targets. The second is to do with balance. And balance can be any number of things, but the things you'd recognize is the balance between risk and return, short and long term, high and low risk, etc. And then the last thing is to do with alignment. So making sure that the portfolio is actually doing what we intended to do. So aligning with our vision and strategy for the organization. And this last thing about alignment is quite difficult, because what do you do with innovation projects that are really quite far out there, where the strategy couldn't have imagined that they would have emerged? And I've dealt with a number of innovation directors over the years, and what they've often asked for is a line item in the budget which is not designated, which is very, very difficult, because going to the CFO in the organization or the FD and saying, can I please have an amount of money allocated for projects which are left field juggernaut type projects that will come out of nowhere and need resource, or for great ideas that may emerge that we don't expect, that come out of initiatives that we are kind of on the periphery of, but might not actually be able to engage with. So there's something there about alignment having a kind of limited benefit, but nevertheless, for the most part, for a big proportion of our portfolio of innovation, we want to make sure it aligns with the strategy we are trying to achieve. So just to recap then, it's value maximization, balance, and alignment are the objectives we're trying to achieve for our portfolio. If we then link that to how we try and grow a business, so elsewhere I've talked about over time, we have certain targets. Organic growth will give us an amount of return, but often those targets there's a gap. And the question is, how will we actually achieve that gap? So this growth is in excess of our natural organic growth. And the way we can think about that is to start, first of all, by putting down what the various different growth paths might be that we could pursue. And the way I like to think about this is to divide it up in a way which talks about so-called core space, and then what I would call next space, which is often called adjacencies. So things that are quite close to core, but not as radical as to be white space. So next space, and I split them between next space product and next space market. And what I mean by that is obviously this is an adjacency to an existing product, which is moving it on in the mind of the customer. It's attracting new customers or more of the same customers, whereas this is actually taking ourselves into markets that we may be vaguely familiar with, but we haven't actually tackled yet. And then the piece which is left is what Mark Johnson would call the so-called white space. And I quite like this way of thinking about the different ways in which we could grow, because there's been research published which helps us from a portfolio perspective to try and understand what the implication of this is. Now, if you have 100% of budget to spend on innovation in an organization, where would you place your bets in order to have a balance in your portfolio, and in order to retain the alignment that you require, and in order to value maximize? And that's why seeing this picture starts to become quite important. If I just take a step backwards, we would never say, it wouldn't make any sense to say that we don't innovate in the core space. Of course we do. And in fact, the bulk of our innovation spend should actually be in this core space. The way in which we would evaluate projects that are coming into the core space is they would have a clear business case. They can show, because of market data, because of productivity data, etc., we can actually show how the investment in these improvements, in these innovations in our core operations can actually make a difference in the future. So that's pretty clear. The next space market and next space product may be less clear, but also because it's adjacent, there's likely to be a combination of data and some piloting and testing, which is a little bit taken on faith. Here, we have a totally different portfolio mindset. Here you might say that your expectation is that 8 out of 10 projects you'd expect to succeed because they have a business case, and because where we're failing, it's just about a failure of our ability to estimate and guess going forward properly what the market can bear and what the costs of these things might be. Here, it's the complete opposite. Here, our failure expectation is, instead of 2 out of 10, is actually 8 out of 10. And in this particular space, so if I was to just put that down again, so here we would expect 8 out of 10 projects to succeed, and here we would expect possibly 2 out of 10 projects to succeed. So the tolerance for failure in the white space is almost diametrically opposite. And where's this evidenced? Well, the behavior and the culture you'd expect to have going on here is what you would normally see in a venture capital company. So venture capitalists are expecting to invest in 10 projects, and of those 10, they may see one that'll break even and one that might be a blockbuster. And for the most part, you very seldom will see a venture capitalist that's not doing very well. So something about that is going to work. But if you took the mindset, the paradigm, the way of thinking around the core space, where our tolerance for failure must, by definition, be very low, and try to make it work in this environment, you can see why it's just not going to happen. The other thing that is quite interesting is that about 1.5 years ago now, some research was published in HBR, which started to give us an indication of the split of investment between these various different things. So the expectation is that of the 100% that we would invest in innovation, there's 2 different numbers, so I'll give you both. The first number is if we were a traditional manufacturing type business, then the expectation is that 70% would go into the core, 10% here, 10% there, 10% there, which would add up to 100%. So 10% of our investment in the white space, 20% in adjacent, and 70% in the core. Okay, now I'm just going to quickly change these numbers to represent a company which is actually much more high tech. So companies where you'd expect to see the impact of, for example, digital operations. And in that particular case, we would expect to have 45% in the core and 15% here, and 20 and 20. That's the split. So that's a different. Now these are obviously aggregated over a number of companies, but they represent R&D and innovation spend across a very high proportion of the biggest spenders around the planet. They are saying this is the split of investment that you'd expect to see. And just as a matter of interest, as a proportion of sales, there's a bit of variety. So between Cisco, Oracle, Apple, Amazon, at the bottom end they're spending about 3% of turnover, at the top end about 16% of turnover on innovation. So you get an idea of nominally the total amount of investment overall. So the balance and the alignment is obviously something that is guided by the strategy, but in general terms, there's 2 big deals here. One, how much do we invest in each of these parts of the portfolio, top-down strategic bucket type investment, and 2, what are we talking about in terms of a culture differential between the core space and the white space? Here we have to have a venture capital mindset. We're investing 15% of the total innovation spend in the organization in white space projects. We expect 8 out of those to fail. That is perfectly acceptable. Why? Because it's the price of learning. That would be us going out to the market and testing and piloting certain things, and they may fail and then we withdraw them. So if you look at companies like Google and a number of others, you see them putting things into the market, they try them for a little while and then they close them down, take them away. And actually that behavior has been going on for quite a long time, and you have to obviously look for it, but it's definitely there. Whereas here our expectation is, as per usual, high performance, very much about success all the way, business cases that are robust. We're not going to take these bets unless we are pretty sure that they're going to come off. So here we'd also be looking at lots of smaller bets, so that if the failures are there, they're not going to take the company down. This is not bet the farm. So this is not for example, IBM doing the big investment they did when they transitioned from mainframe computers to mini computers. They did literally a better farm type transition when they eventually got around to that. Okay, so that's the story about the portfolio in terms of investment top down and how we could fund these various different growth paths and the related cultures.